Hello and welcome to this webinar on the World Energy Outlook 2016. My name is Tim Gould. I am the head of the Energy Supply Division, one of the two divisions that produces this World Energy Outlook within the IEA. As you may be aware, the World Energy Outlook is an annual publication. We provide long-term scenarios that look out to 2040. In the webinar today, we'll be looking at two of those scenarios. The main one is our so-called new policy scenario, and that's something that incorporates all of the things that not just the governments have in place, but the things that they say that they intend to do. And this year has been a particularly opportune one in that respect, because we have over the last year a rich body of work in the climate pledges that were submitted in advance of the Paris Agreement. So that's given us a lot to work with when we think about how policies might evolve over the period to 2040. So our main scenario incorporates our reading of what those climate pledges mean for the global energy system. And to help us think through the implications for oil, natural gas and coal, I'm joined by two colleagues who have led the work on the fossil fuels within the World Energy Outlook. That's Christophe Macglade, who's been with us at the IEA since 2015. He leads on oil. He has his PhD from UCL in London. And Johannes Truby, who's been with us since 2012. He leads on natural gas and coal and has also done a lot of work on power markets. And he has his PhD from the University of Cologne. So the intention over the next hour or so is to talk you through some of the main findings, and that'll take us with slides around 25 minutes or so. And then we'll move to question and answer. We have received some questions already from some of the participants, so thanks for that. And we'll talk through a couple of them. And then you also have the option to submit questions using the question box on your screen. Just to clarify that this webinar is being recorded, and we will make the recording available to consult via the IEA website, which is at www.iea.org. So without further ado, I wanted to just talk through some of the broad context for our work, talk a bit about our oil demand, and then hand over to Christophe and Johannes to talk in more detail. One way to think about the future is also just to compare it with the past. So this slide looks at how the last 25 years have evolved, which fuels met the increase in overall energy demand. We've had about a 60% increase in primary energy demand since 1990. You can see that partly as a product of China's very rapid rise during that time, coal was the winner in that particular race. But if we look at the outlook to 2040, the first thing is that there's a much smaller increase or anticipated increase in primary energy demand. So that's around 30%. That's the product of some structural economic changes in the global economy, but also the increasing efficacy of energy efficiency policies worldwide. And coal, from being a leader, falls to the back of the pack. Oil, which I'll return to in a second, contributes around 10% of the increase in global energy consumption. The one element of continuity is natural gas, but the clear winner in this year's outlook is low carbon sources of energy. That's divided between nuclear and renewables. Of the nuclear wedge that you see there for the period to 2040, around 40% of that is reactors that are already under construction. Most of those are in China. But the important point to note is that this is not this increase in low carbon energy is not the product of a few countries. It's really a worldwide phenomenon. China around a quarter of the increase, but it's a very broad spread of countries that are participating in this transformation. I wanted to just return to the oil demand segment of the previous slide and to look at why we think that oil demand the growth will slow, but we don't yet see a peak in oil demand before 2040. You've probably seen in the press a lot of discussion about peak demand. Based on our reading of the Paris pledges, we don't yet see it, and I wanted to talk through why. And the way I'm going to do that is just by considering in turn various different ways in which oil is used in the international, in the energy system. In the case of power generation and the use of energy in buildings, there are multiple alternatives to oil, whether that's gas or renewables or electricity in the case of buildings. And so it's no surprise perhaps that we see the contribution, less oil being used in those sectors in 2040 than today. What's new for us in 2016 is that the amount of oil used in passenger cars in 2040 is less than the amount that's used today. And that's despite an envisaged doubling in the global passenger car fleet. So at the moment, there's around 1 billion passenger cars on the road. By 2040, we would anticipate that that number increases towards 2 billion, but the amount of oil used in that sector decreases. Why is that? There are three main reasons. The main one by far is the impact of increasingly stringent fuel economy standards. There's also some substitution away from oil towards natural gas and biofuels. But the one that tips the balance, and the reason why that column is in the negative in this World Energy Outlook, is because of the rise of electric vehicles. So from around 1.3 million electric cars on the road today, that number reaches something around 150 million in our main scenario, and that displaces around 1.3 million barrels a day of oil. So if all of this is true, then why does demand continue to increase to 2040? 4 reasons for that, and that's oil use in maritime transport, it's oil use in heavy goods vehicles, it's jet fuel for aviation, and it's our continued demand for plastics and other products of the petrochemical industry. What do these 4 sectors in yellow all have in common? They're all sectors in which energy efficiency policies are not very widespread and are in any case quite difficult to implement. They're also sectors in which substitutes for oil are that much more difficult to find. And with that, I'd like to turn it over to my colleague Christophe McGlade, who's going to talk through some of our findings on the oil supply side.
So, in order to understand the dynamics on the supply side, it's first important to understand what impacts the fall in prices that we saw since mid-2014 has had on oil supply prospects, because we've seen quite a dramatic fall in upstream investment from companies and national oil companies. The first thing to note is that tight oil had been rising at quite a rapid pace, and since the fall in oil prices, it's down by around 15% from its peak level. Discoveries of conventional crude oil have also fallen to a 70-year low in 2015. But the thing that we are going to focus on here is the dramatic fall that we saw in the approvals of new projects. And I should point out here that our analysis is on physical barrels of oil rather than investment in dollar terms, as it's easier to compare historical and future physical volumes than future investment needs. So in an average year since 2000, around about 15 billion barrels of oil was within projects that were approved each year. But in 2015, we saw quite a steep fall of around about 2/3, such that the volumes that were approved fell to levels not seen since the 1950s. And these conventional crude oil approvals are important because they replenish the supply from conventional oil projects that still make up around about 70% of global oil production. And these sources of oil are consistently being drained by declining output. So with the declines in conventional crude oil are roughly equivalent to losing the current oil output of Iraq from the global balance every 2 years. And it's also important to recognize that the impact of a gap in this pipeline of new projects is not going to be felt immediately. Conventional projects typically take around 3 to 6 years from the moment of approval to when production first begins, and then another few years for those projects to ramp up to full production. But a drop in approvals will be felt eventually. So what does this mean going forwards? Looking at the picture to 2025, we see oil demand growing by around about 5 million barrels per day, and also a rebound in tight oil production. And so with just a single year of low approvals, we consider that there's around about 16 billion barrels of new projects need to be approved each year from 2016 on to 2025 in order to ensure that the increases in demand can be met, given the drops in supply that are currently ongoing and constantly ongoing. This level of approvals is similar to what we've seen since the 2000s, so there's not really any major issue there in the supply line. However, 2016 hasn't really shown much of a pickup in approval levels, and that means that the subsequent level of approvals that are necessary from 2017 onwards to 2025 is greater than just a single year of low approvals, but it's still manageable. But what we want to highlight here is if approvals remain suppressed into 2017 for a third straight year, making up the lost ground starts to look increasingly difficult. So it would require a sustained effort by the industry beyond anything that's been achieved since the 1970s. So the summary of this is that if investment remains low in 2017, it starts to look increasingly unlikely that supply can be met and can meet the rising demand level seen in the new policy scenario without rapid price rises. I mentioned that those levels of conventional crude oil approvals took into account that there would be a rebound in tight oil production. We're going to focus on here is tight oil prospects in the United States going forwards. And the key question is whether tight oil, which is generally much faster to respond to price rises, could ride into the rescue and fill in any gap left behind by the lack of conventional crude oil. And this very much depends upon timing. So if we look in the central scenario, we expect US tight oil production to be relatively flat in 2017. But then, as prices start to rise going into the 2020s, we start to see tight oil coming back into the mix. And over the next 5 years, around about 1.5 million barrels per day of additional production comes through from the United States in tight oil. But once we start to reach the 2020s, we see a slowdown in the rate of ramp up of tight oil and then a plateauing in production going forwards. And this is because once we reach the 2020s, we anticipate that the most economic sites, the sweet spots within all of the shale plays in the United States, will start to become depleted. And what this means is that the operators will be forced to move to less productive areas, and that each new well that they drill will yield increasingly smaller returns. And given that the impacts of the low level of conventional approvals is not going to be felt until the mid-2020s, whenever tight oil is on that plateau, we don't believe that tight oil should be relied upon to satisfy any major supply shortfall in conventional crude oil. However, it's also important to recognize that there's a high degree of uncertainty in this outlook for tight oil, and our projection is particularly sensitive to the assumed tight oil resource base. So in our central case, we assume that there's around about 80 billion barrels of tight oil resources left that can be exploited in the United States, but it's equally valid, it could be significantly more or less than this. And so we examined the impact on production of resources spanning the range of estimates that currently exist, from down at a low point of around 30 billion barrels remaining up to about 120 billion barrels of tight oil remaining. And if we look at 2025, we see that the production potential spans an equally wide range. So from a low point with 30 billion barrels of tight oil resources of production of about 2 million barrels per day, up to the top of the range there of about 7 million barrels per day. And what's perhaps most of note is that if the resource base is greater than around about 100 billion barrels, we'd anticipate that the United States will eventually become a net exporter of oil by around the late 2020s into the 2030s. But our message from the oil supply side is that without a pickup in investment in 2017 or a rapid slowdown in demand growth in the years to come, the stage is being set for the next boom and bust cycle for oil. And with that, I'll hand over to my colleague Johannes for the outlook on gas and coal.
As you recall from one of the previous slides, it's natural gas that performs best of all the fossil fuels in our outlook and sees a 50% rise in consumption in the period to 2040. Gas is a convenient fuel, especially in the non-energy intensive industry branches like manufacturing, food and beverages, or textile, but also in the chemical industry where it serves as a feedstock, for example, in the production of fertilizer. Strong economic growth, especially in developing countries, translates into robust growth for the fuel. But one of the key things that needs to be in place to underpin this growth is adequate gas infrastructure. Industrial gas use accounts for nearly 40% of the growth in global gas demand over the outlook period. Now, the power sector offers similarly impressive growth opportunities for the fuel. Global electricity demand increases by 2/3 over the coming 25 years, and the targets of the climate pledges included in the Paris Agreement, together with growing awareness of air quality, make a very strong case for gas in power generation. Nevertheless, the power sector is also home to the biggest uncertainties for the fuel's future prospects. Commercially, gas has a hard time competing against coal in most gas importing regions, where gas is more expensive than coal. And at the same time, gas vies with renewables for policy support, and this creates a risk for gas to be squeezed between robust coal on the one side and rapidly increasing renewables on the other side. Clearly, supporting the integration of variable renewables is an important new task for gas, but this is primarily a technology opportunity, since the volumes that are used to provide flexibility in the power sector are relatively small. Developing countries in Asia account for 80% of the growth in global gas demand, and this effectively limits the role of gas in buildings. With the exception of parts of China, heating demand is moderate in this region, and transport sector gas demand is held back by the investment dilemma around infrastructure. But how gas fares will also be determined in the coming years by a major set of changes in the way that gas markets operate internationally. We're all still familiar with the shale gas revolution in North America, and now we're on the verge of another gas revolution, and this time it's driven by LNG. And that revolution will reshape gas markets for decades to come. A surge in capacity over the past decade has pushed up the share of LNG in trade to 42%, and with demand growing less than anticipated by the investors, this has left global gas markets awash with LNG. And over the next 5 years, another 130 BCM of liquefaction capacity are slated to come online, mostly in the United States and in Australia, and this will further strengthen the bargaining power of gas consumers. And it's the prolonged buyer's market that will change the way the gas market functions. An increasing number of free, unattached LNG cargoes are currently looking for a home, and this is leading to a rise in spot sales, which in turn is spurring changes in the pricing mechanism, gradually moving away from the traditional oil indexation more towards prices that are set by gas-to-gas competition. At the same time, it's also spurring contractual changes, among them the removal of destination clauses and shorter contract durations. New players such as Mozambique, Tanzania, and Canada, which are joining the LNG export business in the latter half of our projection period, also make an important contribution to the emergence of a truly global gas market. And by 2040, more gas is traded as LNG than via the traditional pipelines. But there comes a point in every revolution when it's clear that the old rules have gone, but no one's quite sure yet what the new rules of the game are. And this is where we are today. And that presents a risk. The current overcapacity in LNG is, according to our projections, absorbed by the mid-2020s. But new investment decisions are needed well before this point due to the long lead times of the projects. And the outlines of a new gas market order will need to become clear soon if we are to avoid a new round of market tightening in the 2020s. Coal markets have seen a very dynamic period this year, with prices surging by more than 50%. The reasons for this can be found primarily in China, the country which accounts for nearly half of the world's coal production. In light of the high coal prices that we've seen between 2008 and 2011, and in the false anticipation of continued strong coal demand growth, a massive mining bubble has emerged, leaving the coal market oversupplied and sending coal prices to rock bottom. It is estimated that overcapacity in China amounted to 1,000 MTCE at the beginning of the year. And just to give you a feeling for the number, that is more than the combined coal production of the world's second and third largest coal producers, the United States and India. Shedding capacity has thus become a policy priority for China, and the various capacity controls that were introduced over the course of the year have proven effective, but perhaps a bit too effective. Chinese authorities are currently relaxing some of the previously introduced measures as they seek to find a balance between capacity cuts, job losses, and coal price jumps. Reducing excess capacity is particularly pressing over the medium term of the next couple of years. But with Chinese coal demand having peaked in 2013, the country's coal production is also set to enter long-term decline. Now, managing the social implications of a transition for a coal industry that still employs more than 4 million people is clearly also a long-term challenge. And it's a challenge that is also of critical importance for coal producers around the world, as the current market events show that it's really China that holds the keys to the global market balance. The first decade of this century looked like the return of King Coal, with China leading the charge in pushing coal consumption higher. But the boom is over. Global coal demand declined in 2015 for the first time since the late 1990s. And in our projections, global coal demand is leveling off over the next 25 years. But the global trend masks stark regional contrasts. Some of the higher income economies like the European Union or the United States, often with flat or declining overall energy needs, make large strides in displacing coal with lower carbon alternatives, especially gas and renewables. Most importantly, China joins this group over the outlook period with, as I said, coal demand having peaked in our view, and coal demand set to decline in China by around 15% to 2040. However, lower income economies, notably India and Southeast Asia, face surging energy demand and cannot, at least for the moment, neglect a relatively low-cost source of energy, even as these countries pursue other sources in parallel. The policy headwinds facing coal are largely driven by environmental concerns, but again, the accent varies by region. In the OECD, the main concern is carbon emissions, but in the developing world, there is also a strong awareness of coal's contribution to the problem of poor air quality. Where coal-fired boilers continue to be built, this is putting the accent on high efficiency and advanced pollution controls. But even so, coal is projected to fall back in the global energy mix behind natural gas. Over the longer term, the future of coal is increasingly tied to the commercial availability of carbon capture and storage, as only abated coal use is compatible with deep decarbonization.
Thank you very much, Christoph. Thank you very much, Johannes. I wanted to round up this presentation with a few words on what all of this means for climate objectives and how this picture might change in a 2-degree scenario. We've talked today about fossil fuels, but the big story of this World Energy Outlook is really around renewables, and there will be another webinar in 2 days' time on the 8th of December, precisely dealing with the analysis and findings on that topic. But the net effect of the changes that we've talked about and the large expansion in low carbon sources of energy that we anticipate over the next 2.5 decades is to slow the growth that we've seen in energy sector CO2 emissions. So there have been many changes that would be certainly positive from a climate perspective. We talked about the peak of coal consumption in China. There's also anticipated to be quite strong improvements in energy efficiency, so the improvements in the energy intensity of the global economy are more rapid than we have seen in the past. And all of that contributes to the picture that you see here. So over the period since 2000, every year, on average, there's been an extra 650 million tons of CO2 going into the atmosphere from the energy sector. And that slows over the period to 2040 to around 150 million tons. But you're also all familiar that that is not going to be enough to get us onto a trajectory for emissions that's consistent with a 2-degree outcome. In fact, our central scenario is more like 2.7 degrees Celsius by the end of this century. And so a 2-degree scenario would require a much stronger policy push in favor of low carbon sources of energy. It would require, for instance, instead of 150 million electric vehicles on the road by 2040, more than 700 million. Instead of a 40% share of renewables in power generation, something closer to 60%. And we need to also extend our horizon out to 2100 to think through the long-term implications of that transformation. So that implies that by the end of this century, we would have a situation where the emissions from any emissions from the energy sector would need to be compensated by technologies or efforts to remove carbon from the atmosphere. And if you think beyond a 2-degree scenario into the kind of well below 2 or efforts to pursue 1.5 degrees outcomes as mandated in the Paris Agreement, then what you need to do is take that point at which the green line intersects with the 0 and drag it back forward in time. Indeed, if you're going to have a reasonable chance of a 1.5 degree outcome, and you're not going to go net negative, in a sense, that green line cannot go beneath 0 and withdraw carbon from the atmosphere, then you'd need to hit 0 at around the year 2040. That is the speed and scale of transformation that would be without precedent in energy history. But if we just consider the 2-degree scenario for a second and look at what that would mean for the fossil fuels. This is the picture in our main scenario. So this is the picture that arises from the implementation of the pledges, the climate pledges as they stand at the moment. Oil, and particularly coal, are hit hard by the requirements to remain within a constrained carbon budget. It's only really natural gas that sees higher consumption in a 2-degree scenario in 2040 compared with today. And as we move on to now the questions, I'd invite you to send your questions in. Thanks very much to those who have already sent some. I'd like to turn to Christoph and ask, there's a lot of discussion about the implications of a 2-degree scenario for fossil fuels, particularly for the need for continued investment in fossil fuels. That investment is obviously going to be affected by stronger policies, a stronger push on decarbonisation. And there's likewise a strong strand of discussion around the possibility of stranded assets in the event of a 2-degree scenario. So how would you characterize those risks, the need for any additional investment in fossil fuels in a 2-degree scenario?
Thanks, Tim. For the stranded asset debate, it's important to distinguish between a number of different aspects, as whenever people refer to stranded assets, they can often mean different things, and the different aspects of this debate are often all conflated together. So whenever we talk about stranded assets, what we're referring to here is in capital investments into fossil fuel production that are made but end up failing to recover the costs because of any climate policy that comes through. So for oil fields, this could be because demand decreases, as we see in that picture, but then you don't require a field which has been developed, and so that field is then shut in. Alternatively, because in a lower demand trajectory you're going to have lower prices going forwards, a stranded asset could arise because a capital investment is made in the anticipation that prices are going to rise, but then prices don't rise to the same extent, or prices rise and then peak and fall, and so the capital investments don't ever make their money back again. But it's important to recognize that in the 450 scenario, we don't actually see there being a particularly huge level of stranded upstream assets coming into the mix. And that's because in that picture we see there, although demand has peaked and by the 2030s oil demand is falling by around about 1 million barrels per day, the underlying declines that I talked about earlier on in supply remove around about 3 million barrels per day from the global oil balance. And so because that 3 million barrels is greater than the 1 million barrels decline in demand, that means new investments are still always going to be necessary in the 450 scenario. So what we find and what we discussed in this year's outlook is that if the low carbon transition is well signposted and if policymakers are clear, and if companies are aware that this transition is happening and make adjustments appropriately, this will limit to a large extent the extent that there are large losses by companies or by countries. But it's important to recognize here that the main risks that there could be, and there could be a much greater level of stranded assets, is if there's inconsistent policy making. So if policymakers imply that there won't be a huge level of climate policy over the next coming years, but then rapidly increase ambition, or if fossil fuel companies misjudge the level of oil demand going forwards, and so make investments which therefore are not required under the 450 scenario. So under those situations, there could be quite severe financial losses, but in our central 2 degrees case, we don't see the level of stranded assets being overly large.
Thanks, Christoph. A question to you, Johannes. You talked a lot about the pivotal role of China in the coal market. China's already a major player in all aspects of coal, including the way that the international balance works out. At the moment, China remains a net importer or an importer of coal, but you talked about the social implications of the transition. Supposing those became difficult to manage and China, in a sense, reined in the reductions in overcapacity, is there a possibility in your view that China could go back to exporting coal onto the international market, and if so, what might be the implications of that?
Yeah, thank you, Tim. That is the question of China becoming an exporter of coal again is very uncertain, and let me briefly outline why we think this is there's a huge uncertainty attached to this. China was a major exporter of coal until around 2009, when it turned into a net importer. And in our central scenario, in the new policy scenario, we expect China to remain a net importer of coal over the outlook period, albeit on a declining trend. However, it's important to know that China's trade balance is a relatively small element in the country's coal balance. It's only around, imports are only around less than 10% of the country's demand, and therefore the trade balance is very sensitive to the vicissitudes of the domestic market. Now, our long-term import trend is underpinned by 3 key assumptions. The first one is that state interventions to influence the competitiveness of Chinese coal vis-a-vis coal imports remain minimal. The second is that the ongoing capacity reduction and industrial restructuring is successfully implemented and social hardship is being avoided. And finally, that the bulk of the Chinese coal production remains costlier than imports. Now, any of these assumptions is uncertain and could turn out differently in the future, and thus could lead to China becoming an exporter of coal again. And clearly, if China were to become a net exporter of coal again, this would have major ramifications for the international market, possibly triggering another round of mine closures and bankruptcies around the world.
Thanks. We've had quite a few inquiries about the oil demand outlook, and particularly, the projection on electric cars. So, I'm going to ask you, Christoph, what could change our position on that? Is that a blind spot for our outlook? What if battery costs come down much more quickly? Could you talk through the 150 million number and any sensitivity around that?
So, as background, the number of electric vehicles that there were on the road in 2015 reached about 1.3 million. And over the coming 5 years, under our central case, we expect that number to increase by around about 50% year on year. And eventually, however, there's going to be a bit of a slowdown come 2025, and that's how we end up with our 150 million number in the central case in 2040. And the really key aspect for why we don't have a more optimistic outlook on this is because of costs, and costs remain a real bottleneck for electric vehicles. And it's clear that policymakers need to really work on increasing the value proposition of electric vehicles to take account of this new technology that's available. So to put some numbers on battery costs, and for battery electric vehicles in 2015, we estimated that the costs were around about $210 per kilowatt hour, and under the central case, we see these battery costs coming down to $125 in 2025, and then about $100 per kilowatt hour in 2040. But still, if we take 2025 there, with battery costs at $125, the additional cost of a battery electric vehicle and home charger is around about $6,500 over a conventional car equivalent in the European market, and there will be even more than that in the United States. So this is really quite a large number, and the payback periods for cars by consumers tend to be on the order of 2 to 3 years, and even with that dramatic reduction in battery costs, you don't get down to the 2 to 3 year payback period that consumers require. We did look at a case in which battery costs came down faster, so come down to $100 per kilowatt hour in 2025. But even then, the cost of a battery electric vehicle and home charger is still around about $5,000 more than the conventional equivalent in Europe. So still a large way to go. Just perhaps worth pointing out, you mentioned what needs to happen under the 450 scenario, under the 2-degree scenario. And in that case, we see 700 million electric vehicles on the road, and that's because you get enhanced policy support for electric vehicles. And you can get into a virtuous circle whereby increased policy support helps lower the cost of batteries, and that therefore encourages more policy to come through and encourages more uptake of the cars. And so that's the way in which we see the 700 million number coming through in the 450 scenario. But also it's important to recognize that there's other ways in which policymakers can encourage consumers to use battery electric vehicles besides just helping to provide subsidies to reduce the costs. They can allow electric vehicles to park in places which conventional vehicles can't, to drive in places they can't, to drive at times whenever conventional vehicles can't. There's lots of other options available to policymakers other than just subsidizing them.
Thanks. We're now going to come back to coal, and we will come to natural gas in a minute. But there's a question, or there's a knot of questions around the way that the coal outlook could evolve. The role of CCS in our projections, what role for so-called clean coal technologies in our outlook, and also the risk. I mean, Christoph talks about the risk of stranded assets, but referring primarily to upstream oil and gas. There's perhaps a much larger risk in the coal-fired power generation sector, and so can you talk through some of the issues or the way that we would see that situation evolve? I think probably particularly in relation also to a 2-degree scenario as well as.
Yeah, thank you, Tim. As I said on my coal slide, coal's future is increasingly tied to the commercial availability of carbon capture and storage, and that is very important to note in a 2-degree scenario. In our 450 scenario, by 2040, globally around 430 gigawatts of power plants are equipped with CCS, and around 60% of this are coal-fired power stations. And these power generations, they generate around 10% of the world's electricity in 2040. Obviously, China is key in developing CCS and bringing it to its marketability, along with a few other important coal-consuming countries. And China is also one of the 10 countries that has actually mentioned CCS in its NDC, and with a large coal-fired power fleet in China, there are good possibilities also to retrofit power stations with CCS. However, given the slow pace at which CCS projects are being deployed and demonstrated and tested in recent years, we have slightly revised down our CCS outlook in the 450 scenarios compared to last year. But the important thing here is that this should not be misinterpreted as a recommendation to reduce the spending on CCS research and development. The technology remains a very, very important element in decarbonizing the energy mix, and it is also in the long term essential if biomass-based CCS is to be deployed as a means to achieve negative emissions in the very long term. And a few words on stranded assets. When talking about stranded assets and coal, we need to look very carefully at the supply chain. And coal mining assets are not very capital intensive compared to oil and gas upstream facilities. So the main element that is at risk is labor in the mining industry, and that's obviously a very, very important concern, and that's also what we note what plays a very important role in China's industry restructuring at the moment. But then the capital intensity is very high in the power generation sector, in the coal-fired power generation sector, and that's where coal-fired power stations are much more capital intensive than, for example, gas-fired plants. So this is where the primary risk for stranded assets lies. But in this context, it is very important to see that CCS is also an asset protection strategy for coal-fired assets, and this again underscores the importance of CCS in a 450 scenario.
Thanks. We've had a question in regarding the points you were making, Christoph, about the risk that we may be entering a period of oil price volatility. So supposing what you were talking about comes true and that we have another year of suppressed or low investment in new conventional crude projects in 2017, when might that start to be felt in the oil market balance? So are we talking a year, 2 years, 5 years, 10 years?
So as I mentioned, the important thing to recognize is that this is not going to happen tomorrow. A low level of approvals, even for 3 years, isn't going to have an immediate impact on the global oil balance, and that's again because you have a relatively long lead time between when a project is approved and when it comes on stream and before it ramps up to maximum production. So a shortage of oil is not going to happen in the immediate time. And also it's important to recognize that we did come out of a period of very high levels of investment. Whenever prices were high from 2010 to 2014, times were good, there was a high level of investment and a lot of approvals came through. So we're still seeing a number of projects being developed over the coming years as a result of that investment which happened. As a couple of examples, Canada, we would see a number of we would see production continuing to rise as over the next few years as new projects come online. Brazil similarly had a huge level of investment, and those projects are going to come online over the next 3 to 4 years. But then it's after we see these projects come into the mix, that's when we start to see this shortage beginning to bite. So really, the time whenever things start to look increasingly tight is once we reach the end of the decade and looking in towards the mid-2020s. It's impossible to put a precise date on this because there's so many different factors that are at play. And of course, it's possible that after 2017, the industry is incredibly successful and more successful than ever has been in the past at approving new projects and getting new approvals there, so that the level of resources that we see as necessary do in fact come through. But we think that looks increasingly unlikely, and so the market really seems to be tightening once we get to the end of this decade and looking on for a few years after that.
Thanks, Christoph. We've had a question about natural gas prices, and more specifically about natural gas pricing. So, Johannes, how do you think that would evolve, or how does it evolve in the main scenario? To what extent are prices in some markets continue to be set with reference to oil products? To what extent are we moving towards a more, in a sense, a more globalized gas market?
Yeah, thank you, Tim. This question on gas prices clearly needs to be seen in the context of the current market events and the LNG revolution that I've described previously. Now, we're currently seeing a lot of contractual changes and a lot of changes in how the price mechanisms work, and this is going to have longer-term implications for global gas pricing. So one important thing to note is that in Asia, where oil indexation is still very, very common today, we see a declining importance in oil indexation. That's obviously not going to happen overnight. It's going to take time. It's a gradual process, but this is certainly something that becomes very obvious in the 2030s, for example. That means with a strong growth in LNG trade, we see also the United States with increasing LNG exports become much more important in global LNG pricing. So in the longer term, the difference in the LNG prices between the different regions are primarily caused by the cost of moving LNG from one region to another.
Thanks very much, Johannes. I'm just going to respond to a couple of questions that came in on in a sense, more points of detail. There's a question about petrochemical feedstocks. The large rise in that I showed in the slide in the use of oil products as a petchem feedstock. The question came in is, why don't we see more of a switch to natural gas or to ethane? Now, in terms of a switch to natural gas, I mean, there is a large increase in the use of natural gas as a feedstock, around 200 billion cubic meters in 2040, more than we have today. Just in relation to ethane for us is NGL. It's part of our oil product calculation. So that 6 million barrels a day increase includes also, it takes account of well, this basically shared between naphtha, ethane, and LPG as a feedstock. There was also a question about the use of LNG as a bunker fuel. Many of you will be familiar with the decision by the IMO recently to introduce a cap on the sulfur content of fuels used in the maritime transport sector. That is obviously good news for LNG, and there's certain infrastructure that needs to be in place before it can be taken advantage of. But in our view, the role of LNG in the international maritime sector does increase quite strongly. Prior to the IMO decision, we were looking at around 50 BCM of natural gas being used in the form of LNG as a maritime transport fuel. After the IMO decision, we would anticipate that goes up to around 80 BCM. I'm going to come back to you, Christoph, with a question about costs, upstream costs. There's a lot of commentary at the moment about the way that costs have come down, particularly in North America, for shale production over the last few years. There's an interesting debate over the extent to which that is now a structural change in production costs, or whether it is in part or in large part even for some a cyclical phenomenon that would be that you'd see a rise in costs again in the future. What is the view on that?
So when looking at costs, I think it's important to distinguish between some of the different types of oil production that there are. You mentioned the very impressive reductions that there have been in the cost of production for tight oil production, and of course this is in large part due to increased efficiency by operators being able to drill more wells for cheaper, using fewer rigs, and a lot of those gains, which have been technology gains, which we've seen coming through, are going to be locked in, and we will see going forwards. But I mean, it's also important to recognise that we have seen historically costs always following changes in prices. Whenever prices go up, costs go up. Whenever prices come down, costs also tend to come down. And the key question then for the rest of the industry outside of North American tight oil is whether this drop is simply going to reverse whenever prices go back up, or whether there is something a bit more structural that's going on. And it's clear that the downturn which the industry has just gone through is more severe than there has been in the past. I mean, a number of drilling and service contractors were increasing capital spending that outweighed the increases in spending from upstream companies. And so in other words, I mean, the service industry is investing for a market that was therefore completely derailed by the drop in oil prices. And so the oversupply that we see in the service industry is going to take longer to work off than perhaps it would have done in previous downturns. But I mean, in our central case, in the new policy scenario, we don't think that in a lot of these cases this is a real structural break with this historic trend. I mean, it's going to take time to work off this overhang in the service industry over the coming 3 to 4 years. And so we don't anticipate there being a huge increase in costs, even though we see an increase in prices over the coming years. But then after this period, we think that the two lines, the cost line and the price line going forward, they're going to start moving in tandem going forwards. Of course, I mean, it's going to be possible that prices don't rise as we project, or it's going to be possible that operators can lock in costs for a longer period of time. But our view is that once we work off this overhang, the costs are going to revert to their traditional pattern of moving in line with prices.
Thanks, Christoph. We are running short of time, but we may have time for one more question, and I'd like to direct that to Johannes, and it's about gas. We've got some low prices for natural gas. You talked about the abundance of LNG, at least in the short term, and yet there is some questions about, who's going to actually use this gas, in particular in some of the, the fast-growing emerging economies across Asia. What are the reasons why that gas isn't being picked up more quickly by potential consumers? I mean, say in India or in other parts of in other Asian economies.
Thank you, Tim. Yeah, I think this is a very, very good and very important question. Obviously, the answer to it needs to be found in the individual systems. Just one example, because you mentioned India, is India power sector. One of the big problems there is that coal is clearly cheaper for baseload generation than gas. But at the same time, with the LNG prices as they are now, there would be a very strong case for gas to make much more inroads in power generation in India. But then there is what holds gas back in the power sector in India is the need for power sector reform, where the distribution companies very often pay more for the generation they buy than what they get from the consumers when they sell the electricity. So they're making losses, and that means that very often they don't dispatch mid-load power plants and peak load power plants and prefer to load shed just because they don't have the incentive necessarily to do so. So that would be one example. Another example is lack of infrastructure, as we see this in many places. Very often in the non-energy intensive industries, as I mentioned before, where there is a lot of growth potential, we see a lot of coal being used in applications where you wouldn't expect coal to be used. And that is very often just because gas is not available, because the infrastructure is not there, and many of these industrial consumers would actually prefer to use, or would have a convenience yield from using gas rather than handling coal and handling coal on site and burning coal, let alone the improvements in local air quality. But yeah, in this sense, it is very often the lack of infrastructure and infrastructure planning that holds back gas consumption growth.
Thanks very much. Our hour is up, so I think that's where we'll close the discussion. I won't try and sum anything up, but just to say that we've tried to cover some of the sort of near-term issues which tend to be around market balances and the process of adjustment that's taking place in different markets. I mean, longer term, the uncertainties and the risks are all, are mostly then policy related, to do with the response of countries to the various environmental challenges, and in particular climate change. Thank you very much to you all for your participation in today's webinar. This is a conversation that we're keen to continue in various channels, so keep your eyes open for other webinars that we will be putting out in the future. The next opportunity will be, as I mentioned, on Thursday, to talk to colleagues who have been responsible for our outlook on renewables. We unfortunately didn't have the chance to cover all the questions. If you'd like to pose any other questions on fossil fuels or any other aspect of the World Energy Outlook, then please write to WEO @iea.org, and we'll do our best to respond. Again, thanks very much indeed.